Hussbus bus stop. JP Hussey here of the Hussey Team Mortgage Advisors with this week's Hussbus bus stop. Hope you guys are good. Today we want to talk about rate locks. Rates obviously a big topic right now, but no matter the environment we're in, rates are always a hot topic. It's just when they fluctuate a little bit more, right? People talk about it a little bit more. But people are always talking about rate locks because it makes sense, right? It's pretty important, okay? So the first thing I'll tell you, like we always harp on, budget, okay? Can't control rates, so do what you can control, right? Which is saying yes or no to a payment on a specific house, okay? So if that payment fits your budget, roll with it, because you'll drive yourself crazy trying to time the market, because you can't time the market. Remember, rates are like a stock. They're always moving, okay? So it's very tough to time, okay? So always work with a team that knows the trend of rates, can give you education so that you can make the right decision on when to lock your rate, okay? Number one, there's some programs out there where you can lock before you have a property. They can get kind of hokey, and I'm going to kind of explain that. But you usually can't lock a rate until you're under contract on a home, or if you're refinancing, already have the home, you can lock whenever, okay? So that's the first thing, all right? You need that property before you can lock in, all right? Because if you don't have a property, there's no collateral there, who knows when you're going to close? And what I'm going to get into, how rates work is when it's locked on the secondary market. Someone's actually paying for that, okay? So sometimes it's not the best to lock a rate way too early, especially without a property, even though there are some products like that. Don't love them, but they are there, okay? So how rate locks actually work on a surface level to the consumer, all right? You have a primary mortgage market and you have a secondary mortgage market, okay? The primary is what we do with you, right? What the loan officer does with you on that front end, okay? We talk about rates. Let's lock it in. And that's all you really need to know. This is my rate. Here's my payment. We're locked in, okay? So when you lock in, you're locked into that rate for a specific amount of time. Now, even let's say it's 30 days. Even that 30 days is coming up and you're still not ready to close. Something comes up. It happens in the real estate market. Things come up, right? You can, in almost every situation, extend that rate. But it costs money, right? And it all depends on your loan amount and basis points, and you can extend that rate, okay? So don't freak out if you see that it's coming expired. Speak to your loan officer. How can we extend this rate? And that's going to be taken on by the loan officer or the lender. They're going to pay that until you close, okay? So the borrower here really doesn't have much skin in the game, right? Until the end, all right? But it costs money, all right? So let's talk about timing of rate locks. In my opinion, in this current market, we like trying to lock when you're about 30 days from closing. That's kind of the sweet spot. We kind of can see where things are trending. Yes, a lot can change in one day, but in 30 days, you kind of know what's going on for the most part. And that's like the sweet zone, right? If you're locking longer out, 90 days, okay, 60 days, 120 days, right? It's going to be more expensive to you, the client, all right? There's going to be extra fees in there, all right, which can make your rate higher, okay? That's why we kind of like that 30-day time frame, in our opinion, okay? All depending on the situation. There's new construction, all types of things. But the reason that a longer rate lock is more expensive, okay, because that lender locking you in, and then they're paying to hold that rate for you on the secondary market, all right? So with rates fluctuating every day, kind of like a stock, what we're saying, there's more risk there to hold a rate lock that long because market conditions change all the time. So that's why that rate lock, the longer out, it costs more, okay? So again, you want to collaborate, you want to discuss with your loan officer, with the professional that follows the markets to figure out what's best for you, okay? But we usually say in that 30-day frame is probably the best situation, all right? Any questions, let us know. There's a lot that goes into rates. What I say is keep it simple. If it meets your budget, roll with it. You can always fine tune it later on, all right? Hope you have a great day. Later. Hussbus bus stop.